Payments Podcast from Bottomline Technologies.
Welcome to the Payments Podcast. My name is Leo Gill, VP of Product at Bottomline, and I'll be your guest host for this episode that explores a new mindset for enterprise liquidity management. More specifically, we're going to unpack how today's changing environment is challenging treasurers to play a more strategic role in their organizations, resulting in an evolution of what typically meant to manage liquidity, from manage current and intraday cash positions to managing the entire cash lifecycle, including issues as cash forecasting and working capital optimization, to ultimately help their companies make better data-driven decisions and thrive in today's environment. Joining us today is a seasoned finance professional with extensive experience as a treasury practitioner and consultant, and founder of Strategic Treasurer, Craig Jeffery. Welcome, Craig.
Leo, it's good to be here. Thanks for having me on.
Great. So Craig, from a treasurer's perspective, how should we think of what enterprise liquidity management means today?
You know, the term ERP has been around for quite some time. We think about enterprise resource planning, and this is oftentimes viewed as an accounting system to track and see where the resources are. And oftentimes includes things like accounts payable, receivable, and some of the financial statement reporting. Enterprise liquidity management is the same type of category that includes the management of liquidity throughout an organization. So when you get down to its core, the core elements are things like managing your cash in different accounts, investments, credit. Then as it continues to extend, you'd say, well, intercompany lending, investment custody accounts are part of that. But as we continue to expand, it includes payments in and out. So the cash conversion cycle, or as we think of working capital, collection activity, disbursement activity also flows into that, how an organization manages their liquidity. And so, as that extends into all types of payments, it can include, third-party financing, access to the capital markets, debt market intelligence. It's how does an organization manage their enterprise liquidity, not just from a snapshot from today's cash position, but extending it outward. So it's really a more mature view. And then there's obviously system implications for this. Just like on the ERP side, it's more of an accounting and a resource planning. This is a liquidity and liquidity planning tool.
Yeah, no, that's really interesting. It goes beyond, right, the short-term view, which we see most treasurers looking at it immediately, and goes to a much longer-term view of the entire liquidity of the company, right? Like, as you said, is looking at the cash conversion cycle, or the entire cash life cycle of an organization, which can be quite challenging. You think about today's environment with rate changes. Think about how many treasurers potentially struggled a little bit this past year on forecasting things like interest expense, right? Even though we've all knew that the Fed was going to hike rates, depending on the industry you were in, if you were a net borrower, it was probably quite challenging to, knowing rates were going to go up, how to estimate and forecast the impact to their organizations. So what other challenges you think are present today for treasurers to roll out this broad enterprise liquidity management process in their organizations?
Yeah, well, I think there's a number of challenges for rolling these things out, and and as a predecessor to challenges for rolling it out is challenges for gaining, company-wide acceptance of this. If we think about an accounting system, the view is we have to have financial reporting. It's historical. What does our statement of cash flows look like historically? What does our balance sheet look like at different points of time? And how did we perform? What was our turnover or income on a gross and net basis? And from an accounting perspective, most of that is historically, is historical. It's looking backwards, what has occurred. It's not into the future. What's into the future in the ERP is what is their demand for products or services or supplies or inventory to meet the needs as they're coming forward from an order perspective. And so there's other areas of the organization that are looking for the supply chain drivers and meeting those, and that's part of an ERP. On the liquidity side, it's this mindset of we need to have liquidity that we can solve our call our financial issues and challenges in the short term, the immediate term, going out a month or two, all the way out to a year. That tends to be the cash forecast level. But beyond that, planning for what does the balance sheet need to look like. But across all those, it's involving more areas of the business as opposed to just what occurs in treasury as a unit, as an area. It's receivables, payables, different admin processes or other acquisitions, capital planning, capital expenditures. All those flow into it. And as you mentioned, the challenges are rates have moved a lot. So inflation has moved. Rates have moved up dramatically, changing us from this free or almost free money environment to one where things cost a lot. And it's moved extremely rapidly while we're looking to make sure we're not in banks that are under threat, as we've had some significant bank failures with certainly more to come there. And so that's the environment. It's harder to get capital. It's more expensive. And this has all shifted very, very dramatically. And so this is a crucial element to that. So to, I think, the core of your question, it's a challenge, and it's one that is vital to the organization's success, accessing liquidity over time as it's needed.
Mm-hmm. No, that's great. It's definitely I think that, the part of the challenge, I think there's the organizational, our organization's ready to really solve these challenges, right? As you're saying, one thing that came to mind immediately was, organizations have multiple systems, which are, for the most part, not well integrated, right? So it's very difficult to have a single view of the liquidity across our organization, especially if you're larger with multi-subsidiaries. And as you know, companies are today using internal systems, and Excel is a really big tool prevalent across multiple companies, which can be quite challenging, right, to solve for problems in a fast manner, right, which is how treasurers are getting more and more challenged to do. And as you started talking about ERP, it comes to mind, of course, there are multiple tools that companies use, multiple internal tools, but in some ways, like, what's the right tool for the job, right? I think that's the biggest challenge I also feel with some treasurers is just not knowing where to start, because they may have, a TMS in their organization or not have a TMS. They may have an ERP or not, and just knowing how do we solve for enterprise liquidity, and what is the actual tool to use. So do you have any, from your experience, how do you see companies solving these problems today from an IT and technology perspective?
Yeah, when we start to think about the tech side of things, what has historically been the case is people buy individual solutions that are specialized, that meet needs, and then they try to connect them together, either gracefully or ungracefully. But this idea of the more I look comprehensively at something like liquidity, the more areas of an organization it touches. There's not one unified system for everything in the world. Across the board, there's this idea of I have to get at data. Data feeds and fuels enterprise liquidity management. It's not just I move money, but I have to access things that influence money. My investment activity, my ability to borrow and tap the different lines of credit, but things like the cash conversion cycle. And there's also a difference between I can see what's going on and I can use levers to help change that. And the more accurately you can see, and the farther into the future you can see, the more time you have to make those adjustments. And same thing with the more you have tools. I have more credit facilities I can use, I've got additional flexibility there. If I have the ability to use dynamic discounting or supply chain financing, I've got additional levers there that can help my partners or myself. But on the tech side, to the core of your question, is companies want to use systems that are very effective, and they don't want hundreds of systems. Now, the idea that there's a single system is not necessarily a key driver. It's like we know that there's going to be multiple systems, there's going to be spreadsheets, but how do we get this bigger view? And so when I think of what's traditionally a treasury management system, I can see what's in my accounts, I can move funds, I can do my cash position, maybe I can even create accounting. That's kind of core treasury activity. When I think about ELM, it's extending on that. It's certainly those types of things, but it allows us to look to the full cash conversion cycle, not just the financing piece. It lets me make those adjustments across the board. So from a technology perspective, it needs to include things, not just the term payments, but it has to include payments that are beyond treasury payments, moving money to pay for debt or investments, moving funds to cover payroll or concentrating funds that exist. I need to be able to manage payments. Why do I need to do that? Our view is that the treasurer is the superintendent of payments. That doesn't mean they control all the payment processes. It just means that they have they're responsible for payment security, understand the relationships that exist, and they may or may not have direct oversight of some of the systems. There could be payroll systems they don't have oversight over. They may not have AP reporting to them and so forth, but they're responsible for superintending payments because that has a factor into liquidity, has a key factor and feedback loop into bank relationship management, and they're in a particular position, a particularly qualified position to help manage that. But it's the superintendent doesn't do everything. They have to work with security, they have to work with AP, they have to work with these other areas. So on a technology standpoint, it's how do I have a comprehensive view and the ability to use levers? I don't just want to see, I want to have the levers, and that's how I can manage liquidity. It's not just enterprise liquidity view, it's enterprise liquidity management. And so it touches on those different areas.
Yeah, no, that makes a lot of sense. What we also see a lot, as a technology provider, is you're absolutely right. Companies have multiple systems, and they're typically not looking for one tool that will do everything in their treasury team. But what at bottom line we like to talk about is the connected finance, right? Is the ability to have your processes connected end to end that can provide treasurers and cash managers with that entire view of the cash lifecycle. And we see quite a lot of integrations that are done across these multiple systems. And of course, not forgetting about the banks, right, which can sometimes be the biggest challenge, are also internal but external to their company. And as companies are starting to even diversify even more their banking relationships, are their banks, how can they retrieve that data and information across their multiple banking portals? How are they connecting that data together? Do their banks have APIs? What kind of support do they have from their banks when it comes to both cash visibility and payments? It's also quite an interesting challenge where we see technology playing a really key role there to help organizations solve for these problems. Which ultimately, as we talked about, is it gets down to you start with visibility. You need to see your data, but act on it, right? So be able to accurately forecast and properly make working capital optimization decisions with that data. So connectivity is definitely key. As you're saying, it reminds me of one case of a customer that we've worked with, where the treasurers really take a very interesting strategic role in their company. So this is a company that's in the hospitality business. So they own multiple properties in the United States. And part of the treasurer's role is to understand where to make investments. Where are people going on vacation, right? Where should they renovate more properties? Where should they divest from properties where the market is not as attractive anymore? Which properties should they buy and where should they buy? Or if there is a potential, natural event like a hurricane, right? Are they properly allocating cash to where they need to in order to answer those challenges that they're being faced as a company. So I don't see a way to do that if you don't have your systems integrated, or it can be quite challenging, right, to do all of this if your systems are not fully integrated.
Well, I think that's a really, really good point, Leo. If they're not integrated, you're integrating the data somehow. It's either being done manually, really slowly, or it's being done, on a more automated basis, far more gracefully. And just like if, I don't know if you get any physical paper delivered or digital paper delivered, but if you get a paper 4 days late, it's good for laying down for the cat. It's not very useful because the information's late. And so too, that's the speed and efficiency of that matters. And the other side too on this element of speed that you brought up, or maybe you didn't bring up speed, but you're talking about the integration. That time domain matters because things move quickly. The failure of banks. We've heard the term "run on banks," and those go back to the Great Depression from 80 years ago or 90 years ago. And you have all these pictures of people lined up around the block withdrawing $500 at a time, and over a period of weeks, the bank runs out of liquidity. And what we saw with Silicon Valley Bank is 42 billion moved out instantly. So that's a sprint, or an instantaneous run on a bank in terms of how much occurred. And our expectations of how we can see what goes on and how we can act have increased, not just from a run on the bank perspective, but from everything is faster. We need to be able to see what goes on more readily, maybe not instantaneously, but far more quickly. And if we don't have these things integrated, the handoffs are slow. And just one other point to that, Leo, is not only is that the expectation, from management that you'll be able to do it more rapidly, it's hard to get staff now, the Zoomers. They won't do it. They won't key stuff in. They say it's dumb, it's stupid. And they'll go across the street or they'll go down the road and work at another organization where they don't have to do it and get paid as much and save themselves an hour or 2 hours of typing and keying stuff. And we can say that they don't work as hard as they should, but they're certainly not willing to do work that can be done in an automated manner. And that's also pushing things in a very good way. So that's a shout out to the Zoomers, that they're helping to push this more automated view that you're talking about, Leo.
Yeah, no, that's great. I was just thinking back and looking at my notes of our conversation I've had with the treasurer a couple of weeks ago, and looking at the amount of time that they spend on a daily basis, over, of course, somewhat of a larger treasury team. So aggregating bank statements 2 hours a day, aggregating the bank statements again intraday, another 2 hours a day, generating cash positions 1 hour a day, generating cash forecasting 2 hours a day. So, and of course, there's more and more, right? There's still reconciliation, journal entries on ERP, reporting, review of fraud and compliance. Just all of these processes being manually, they do add up quite a bit, and it can be challenging for them to really solve for these problems, as you said, in a fast way. So using speed in order to help their companies. Now, with all of this and budgets really being tight, how do you see them being able to make a case? Treasurers being able to make a case in their organizations for additional investment in this area?
Yeah, this is essential for Treasury to do that, and crises help make the case because everyone's alerted to the situation and about how important it is to manage liquidity in times where there's a lot of shift and a lot of turmoil. And so it's important that you make the case strategically and why it fits into the organization's overall activities, and not just a return on investment, but this is, our organization needs to be able to respond, ensure that we have liquidity, run different models for different environments, different risky events or different scenarios, but also bring to light, here are things that have happened over time, including things that have happened recently, so that people say, well, why do we have to pay to get full liquidity? This is a standard of good corporate conduct. This is commercially reasonable. It's not reasonable not to have that, and this is a standard of a minimum standard that we have. And the reason why we need to extend it to enterprise liquidity management is to address our overall objectives. These are the overall objectives, and how that's done, and making the case for individual purchases or licensing of different software has to flow from that. But I think tying to the strategic and keeping people mindful of the dramatic situations that we faced over time and recently is one of the best ways to do it. But continually bringing it back to the strategy is the winning play, and that's because you're competing against other areas for resources. Management has a lot of activity, so does IT, and so bringing it back to those areas matter. And to the extent that you can have vendors support the work as opposed to massive amounts of internal staff, the better it is.
Yeah, no, that makes a lot of sense. In light of just automating the processes and making better decisions, as you said, there are some additional benefits as well. You think about being able to close your financial periods faster. Imagine how many companies are, when they get to the end of a quarter or end of a month, there's that typical rush to combine information from multiple places to actually close their books. And what we see quite a lot is not having the integration, automation, not having a centralized view of their cash positions and managing that way. It makes really, really challenging, and those are tangible results, right? It's for certain companies, it means how you post your results at a particular quarter, and you potentially could have had a much better outcome that you're not being able to recognize because you couldn't really get your financial systems in place to do that. Also, like, another interesting point that we've seen quite a bit is we started talking about this more strategic role of treasurers, where treasurers are being challenged to look beyond just cash, right, and potential financial instruments, but looking at a more P&L view of their organizations. How do you see that evolution of Treasury along the years, where it has been transitioning from this operational function into a much broader strategic role?
Yeah, and sometimes we describe that as Treasury as a partner, not a vendor. A vendor's like, okay, I need some bank services, like go out and get bank services for the line of business, and I just meet the needs as they come up. Versus, I'm a partner. I look forward to what the organization needs from a finance perspective, which has always been the core. But I'm also looking to see how I can help the organization. So this strategic versus operational role, this partner versus vendor role, has continued to grow. Financial risk management always gets a boost during times of trauma, financial trauma. And the other thing too comes from, if I can see something, I know more, I can make better decisions. If I can see something and I have the levers to move them, like for the cash conversion cycle, for AP, for AR, then I'm far more capable. It's like, okay, we're going to run out of money on such and such a date. Okay, that's helpful. So I know I need to do some things. But if we're going to run out of money here, but if I move these levers, we're not going to run out of money. We're going to have excess. Okay, now I have levers to move as opposed to just, like driving in a vehicle. If your dashboard, you've got the information there. It's like, okay, I have this much, this much distance before I run out of fuel or energy. Having the ability to adapt and change what that is far more valuable, far more strategic versus just reporting a number. So I think those are a couple of the items. It's only continued to be more strategic, and that is also fostered by external pressure put on Treasury, but also the development of technology provides more information, more insight, far more information, and as organizations analyze that and deploy levers to use that, it makes Treasury that much more useful to an organization. So I think your point's spot on about that, how that's changing and is only moving in that direction of more strategic.
Yeah, no, completely agree. As you can think of treasurers today having to understand more about their customers in their organizations, right? And be able to help their teams make decisions or recommendations into things like, we should potentially offer early pay discounts to particular clients so we can accelerate collections. Those are not typical things that you would think treasurers would be looking at it today, but the role has been evolving quite rapidly. And really, without the proper tools and without the proper visibility and forecasting, it's quite challenging. So, Craig, thank you very much. This has been a pleasure. For all listeners, this is it for our episode on Enterprise Liquidity Management. So the Payments Podcast can be found on Spotify, Apple, and SoundCloud. So thank you. See you next time.
Payments Podcast from Bottom Line Technologies.